You're listening to Across the Pond, a show about improving the lives of British expats living in America. Brought to you by Plan First Wealth. I'm Richard Taylor, founder, CEO of Plan First Wealth, a cross-border UK-US retirement planning investment management company.
And I am Thomas Quinn. I am president and CRO of the same business.
Jolly good. Jolly good. Right. So, what's on our agenda today? So, today we are covering non-US and non-UK pensions for the US resident. Having previously covered UK pensions and US retirement accounts, we're now going to look to people who have worked elsewhere, who have been on a tour around Europe or the Far East or Africa, wherever, and have picked up other retirement accounts, pensions, and now find themselves in the US, right? But before we do, I need to assure a few corrections, or I'd rather call them clarifications. So I got a gentle wrist slapping from Martha on a couple of points, a couple of throwaway comments from our last podcast. So I just want to issue a couple of clarifications. So I said 401k distributions are always taxable as income, and I was thinking just through a narrow lens, the 401k we see all the time, which is the traditional bog standard 401k. But of course you can, and in some cases people do make contributions to Roth 401ks or even after-tax contributions in some cases, and in such cases distributions may be partially or fully taxable or tax-free, so it wasn't quite as straightforward and simple as I made out. And the other thing is, when we were talking about the exit tax and we were talking about ongoing obligations for US citizens / green card holders and giving up your green card, and I said US residents are subject to tax, worldwide tax, on an ongoing basis, even if they're outside the US and have to do tax returns. Technically correct, but within the context of what we were talking about, irrelevant. What I meant to say was US citizens, because if you leave the US as a US citizen or as a green card holder, that's different. And saying US residents
different
was
than if you were to leave, as a visa holder.
Yeah. So I meant US citizens, not US residents. So with that out of the way, we need to get Martha on at some point. So if you're listening, Martha, there's your put you on notice. Got to show people how we keep the lights on here.
Exactly. Should we start with like the definition? Definition of what we're here to talk about today.
Back to the topic at hand. I think so. We're talking about non-US and non-UK pensions, right? And I think what we're really talking about here, though, is double taxation agreements, because that's what matters when it comes to how is my non-US pension going to be treated in the US, reported, treated, invested, is going to come down to, is there a tax treaty with the US, and what are the terms of that tax treaty? So let's start by explaining what we mean by a tax treaty.
Yeah, so a tax treaty is a bilateral two-party agreement made between two countries to resolve issues involving double taxation of passive and active income of each year of their respective residents and citizens. Income tax treaties generally determine the amount of tax that a country can apply to taxpayers' income, capital, estate, or wealth.
Yeah.
So what does that mean?
What does that mean? It means that there is these two countries have entered into an agreement to I think the objective, right, is to facilitate people, businesses moving around and to not be disadvantaged financially, I think, and to have some rights, this might be the wrong word, but rights respected in the new country, and to minimise, in some cases avoid, but minimise double tax.
Yeah, I guess it's to not unfairly disadvantage citizens of people's countries from moving overseas.
Yeah.
Compared to if you were to stay in the UK or wherever. So I guess that it's trying to make fairness across the board, whether you're an expat overseas or whether you're just still a Brit in the UK or a US person.
I mean, I guess a really basic one would be like, so you're a US resident, you've got let's just say UK pension. There's no double taxation agreement. There is, everyone. There is. But let's just assume there isn't. And you took money from a UK citus asset, i.e. a SIP, that could get taxed in the UK 20, 30, 40%. Well, not 30, but you know what I mean, 20, 40% without a DTA. And then you're a US resident, so US resident taxes you on your worldwide income. The US would want to tax you at your marginal rate in the US, 20, 30, whatever percent. Double taxation, the total tax burden then would be getting into way over 50, 60, 70%. So a tax treaty exists to say, okay, this asset is citus asset in the UK, but because a treaty exists, you can apply the terms of the treaty, and you can say you're only going to get taxed on that distribution, that income in your country of tax residence, which is the US, right? In real terms.
And does it generally work?
Well, if in my experience, it generally works. I think an important distinction to make, though, is, and I had to get my head around this one, is it doesn't guarantee the elimination of double tax. Having a double taxation agreement in place is a great start, but it doesn't guarantee that you're not going to get double tax. It might reduce it, it might eliminate it, but it doesn't guarantee the elimination of it, and that is something people really need to understand and can come as a really nasty shock.
Yeah. How does one find out about it? How do you know?
I think
how are you meant to know as a layman?
Yeah, I don't know how to answer that really, other than a famous example, really. Boris Johnson years ago. I'm reaching back here into the memory bank. Sold a London property for a handsome gain. Now, obviously, as a UK resident, he is he enjoys unlimited tax-free exemption on gain for a sale of your principal private residence. But in the US, as a US resident, citizen, there we go again, a US citizen, as he was at the time, subject to tax on your worldwide income and gains, no matter where you live. You only benefit from a $250,000 exemption, even on your principal private residence. Now that can be $500,000 if you're married and joined it jointly. But either way, Boris Johnson breached this, and the US taxed him, and I believe he paid it eventually, and then went on to give up his US citizenship. So, there's a treaty between the US and the UK. But
you would have thought Boris Johnson would have had a specialist tax advisor, wouldn't you? As a US citizen, which he was because he was born in New York, he has always had US and UK reporting, but there was an oversight clearly, and he found out the hard way, and
he found
and then threw his toys out the pram and gave away his passport.
So, I think for our purposes, I just raise awareness of it, right? If you have assets in another country, not the US, hopefully there's a double taxation agreement with the US. Even if there is, don't bank on it being a catch-all solution and of helping you avoid any and all double taxation agreement, because sadly, that's not the case. Pensions, though. Back to the topic at hand, pensions. So you've worked in in another country, you've built up a pension there, you moved to the US. There is a treaty. Which is a great start. What can you expect?
So you will generally expect gross roll-up of growth on appreciated assets in that pension. So as stocks rises and as your investments rise, generally you'll experience no gains on that growth. Distributions or withdrawals are subject to income tax payable in the country of residence. generally speaking, here, and non-US investment funds. So if you've got an investment fund that isn't based in the US, this might be classified as something called a PFIC, and I don't want to get too technical here, but essentially PFICs, passive foreign investment companies, are they're expensive to hold because
they're a bit of a disaster. We're going to talk about this on our next topic.
Yeah.
So just for now, avoid unless you're confident that you have a wrapper that allows you to hold them. Avoid them is our advice.
But you usually
not that we're giving any
don't
advice on this podcast.
But you usually wouldn't have a problem with holding non-US funds.
I would say hopefully. I wouldn't. I'd just say hope. I mean, I think there's some debate, really, and I think it might vary from treaty to treaty. I'd also go back a stage further, Tom, and say, look, the first stage. So there's a treaty in place. Great. Does the pension that you have qualify as a pension under the treaty? I think it's entirely possible that you could have a pension, but under the treaty, it doesn't qualify as a pension. So that's the first thing. Is that I think that's go. You got to get past go, and then how would we normally expect a pension to be treated if it qualified as a pension? Like you say, gross roll up, so you're not paying tax on gains and income on an ongoing basis. Distributions taxable in your country of residence, i.e. the US, and hopefully PFIC's allowable. But I think there's an asterisk next to that, so beware, because PFICs are nasty, as we're going to talk about. And the last thing I'd add as well is, I believe there are circumstances when you might need to claim treaty relief. So great, the treaty's in place, great, we think your pension qualifies, good, yada yada yada, and that might not be enough. It might be necessary on an annual basis or every so often. I don't know. This is definitely tax preparer, tax advisor territory. I think you might need to actively claim that you're taking treaty relief and you want the gross roll-up. You want distributions to be taxable as income in the future. So anyway, that might be an active step. So
something on your physical tax return.
I think it's a separate
to
form.
state. Really, yeah.
Well, and you actually have to claim treaty relief and maybe even state the articles. Right. We need like one of these alarms or buzzers we're going to hit to say this is tax advice. Please consult a cross-border tax advisor. Don't hold us to this.
Or an alarm system which is just listening in and which goes off as soon as we stray too far.
Yeah, right. I mean, this is the challenge of what we do. Like, we live in this murky area where we have a knowledge and experience of these matters, but they're not our expertise, and we're not qualified and experienced to give advice on them. We're good at identifying them and spotting them and saying to people, you might have an issue here, this is something you need to be aware of. But we don't want to we want to avoid as much as we can crossing that line. And look, if we don't have the answers, I don't know how lay people are supposed to have the answers. I remember this is actually a topic for the PFIC thing, but I've mentioned it elsewhere. I remember a chartered accountant coming to talk to me with a portfolio of hundreds of thousands in PFICs from the 80s. So if a chartered accountant who's doing loads of taxes doesn't know this stuff, there's no hope for most people.
Presumably he was a chartered accountant in the one country.
He was a chartered accountant in the UK. Yeah.
Yeah, but
then
he'd
been in the US for years. No.
Right.
But he was doing his own taxes. He thought, I'm an accountant.
Cross-border.
No, I'm an accountant. I've got specialists. I know this stuff, and I'll learn the US. And then he found out a few decades later about PFICs, and I don't know what happened, but I bet it cost him dearly. It's not fair, but it's the way it is. So, sorry, I took us off topic there, didn't I? A little bit. Where were we? You might need to
DTAs.
Yeah, you might need to claim treaty relief, actively consult cross-border tax advisor. So that's if you have a pension in a country with a with a DTA? What if you have one without a DTA, a double taxation agreement? So, I've actually got an example of this. I have worked with someone who had worked in Hong Kong, and they had a Hong Kong pension from working for their employer, a big bank. And it's definitely a pension. Hong Kong sees it as a pension, but there is no treaty in place with the UK. With the US. So he moved to the US many years ago, now US citizen, and has a Hong Kong pension, which he has entirely reasonably been treating as a pension. But there's no treaty in place. It's not a pension. Oh, and by the way, this guy had a tax advisor from the Big Four when he first moved here.
Right.
Because his company provided. Anyway, we spotted this problem. We spotted several problems. This is one of them. There's no treaty in place. Therefore, it's great that it's a pension in Hong Kong, but it's not a pension in the US. Now, what is it? It depends on different factors, but it's not a pension. And if it's not a pension, that means it's going to be taxed differently. It means it's going to be reported differently. It means the investment it holds might need to be managed differently. It doesn't necessarily mean it's worse. It just means it's different, and you can get yourself into a bit of a pickle, treating something as one thing when it's actually something else, even if that something else isn't actually that bad. It's more the reporting of it that can get you into a pickle. So, it's difficult because it's a pension. So that's really something to be wary of.
Yeah, countries that you have previously worked in have accrued wealth in, and understanding whether they have a double taxation treaty with the country you currently reside.
Got another good example. Got a client who worked, I think it was oil and gas, worked in the Middle East, worked in various places over Europe, and his company for these people who moved around different countries, they had an international pension plan. Literally has pension in the title. It's provided by by a big name insurance company in Europe that everyone listening will have heard of. And the company paid into it, and the employee paid into it. It looked like a pension. It sounded like a pension. It was called a pension. The problem is, legally, it's not a pension. It's not organised as a pension under any country's rules. This insurance company has just structured it to look like a pension, so the employer can provide a way of saving for their employee's future. But it's not a pension anywhere. It's actually a savings account makes access to investments, but it's not a pension. Again, this client, now a US citizen living in the US, oblivious to this. Of course they would be oblivious to this. I just spotted it, and having some experience with this, thought, I bet that's not a pension, and it's not. So this is an example where this isn't even a pension. Like with the Hong Kong example, that was a pension. There's just no treaty. With this, it's not a pension. It doesn't matter if there's a treaty in place with wherever it's actually based, somewhere in Europe. I won't name where, but it's somewhere in Europe, because it's not a pension. But because it's been treated as a pension, it's his retirement account. It feels like a pension. This guy has been treating it like a pension. Again, entirely reasonably, in my opinion, but it isn't. And that could cause problems because it's been reported incorrectly. It's not been taxed correctly from the US perspective, and nastiness ensues.
And generally, the longer you leave these things, the worse they get, don't they?
Yeah.
Because often, if penalties can just increase and interest can apply over years and years.
Yeah.
And also, I guess the thing you want least of all is the IRS to make you aware of this.
Yeah.
That is the most expensive way to find out.
Yeah, and the most stressful, I imagine, as well.
Yeah.
We've been talking about non-US and non-UK pensions, but really what we've been talking about is double taxation agreements. This is these agreements that exist between countries to try and clear up disagreements, discrepancies, avoid double taxation, not eliminate it, but reduce or avoid it, and eliminate it in some circumstances. The other thing with I would caution with double taxation agreements is there's often interpretation. when you're dealing with US stuff, US retirement accounts, that are codified in law, it's black and white. Oftentimes with DTAs, there is an element of interpretation, which is definitely not for us. But again, it just makes it even more difficult, even more challenging, because with many things, you can ask 5 different CPAs. 2 of them aren't going to have a clue because it's got nothing to do with the US, and the other 3 are going to have different answers. So I wish I had a good answer for this.
Yeah, I mean, so even if the double taxation treaty has made a good go at trying to put in black and white the position, quite often there is still a level of grey.
Yeah.
And within that level of grey lives tax opinion, legal opinion, and you just got to find the right people and the opinion you're comfortable with.
Yeah. And look, we say it all the time, and I just can't. The important. I think the only thing you can do is work with a tax advisor, but not any tax advisor. I think you need a cross-border tax advisor, and again, not any cross-border tax advisor. I think you need one who's got specific experience in the country where you have other assets. Yeah, look, if they're spread out across the world, that's one. But if they're mainly in one country, you want to find someone with specific experience for that, because we've come across expat tax advisors, cross-border tax advisors who just, it's that generic. It's international people, and they don't know how to treat a UK endowment, or that this pension I'm talking about from Europe is not actually a pension; it's a savings account. They don't pick up that stuff, and I think you need to be super specialised. I think that's the only insurance policy you can have, and then if there are discrepancies, if these things come to light, you can say, look, I've worked with a specialist in this field. Yeah. What more do you want me to do?
Yeah, trying to find a tax person that works or specialises in people like you. If your CPA works with your neighbour next door that's just a traditional US person, US citizen, never set foot outside the US, then he's probably, or she's probably, or that company's probably not the right one for you.
Yeah. This is for the next podcast, which we'll introduce in a second. But when a CPA, when I mention PFIX, they don't know what I'm talking about. Anyway, right. Everyone's so excited about the next one now. Oh, PFIX. Look, on that note, I tell you what. Before we introduce the next one, let's just. I think I want to just wrap up by, we've talked about non-US pensions, we've talked about double taxation agreements, we've talked about the most common one really, or type of agreement, which is the income taxation agreement. There other agreements exist, estate and gift tax treaties, which dictates the same sort of issues but a tax upon death. And there's no guarantee if a country has an income tax treaty, there's absolutely no guarantee that it also has an estate and tax an estate and gift tax treaty. I think there's much fewer, honestly. The UK has one, but I don't. Right. But I think it's much fewer. And also totalisation agreements, which are these agreements which talk about, it's to do with the social security contributions and receiving benefits if you worked. It's to do with working abroad for a number of years, how many years, paying into which system, when you have to leave. Different agreement, different issues. Not a topic for today. Again, the UK has a totalisation agreement, and we might talk about that in the future when we talk about state benefits and stuff.
We will.
But for now, that is our retirement accounts topic done. All right, we've talked about UK pensions, we've talked about US retirement accounts, and now we've introduced non-US pensions, retirement accounts, policies. So now we're going to move on and we're going to talk about investments, i.e. not within a wrapper, a retirement account wrapper, a pension wrapper, just investing, investing. And
investing outside of a pension.
Yes. And the first topic we're going to talk about next time is PFIX. It's come up repeatedly here. It stands for passive, let me call it non-US investment funds, right? Which is predominantly PFIX, not exclusively, but predominantly PFIX, and which stands for Passive Foreign Investment Company. And we're going to talk about those, what to look out for, pitfalls, solutions, etc. next time we get together.
Thanks for listening to this episode of Across the Pond. This podcast is brought to you by Plan First Wealth. For more information about Plan First Wealth and Across the Pond, visit us at planfirstwealth.com. If you like this episode, consider sharing it with fellow Brits across the US. You can subscribe to future episodes in Apple Podcasts, Spotify, or wherever you listen to your podcasts. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.